Imagine a company that designs, just the most incredible piece of consumer hardware on the market. Let's say it's a revolutionary new smart home device.
Okay.
They launch, right? And the reviews are just spectacular. The orders come flooding in. We're talking millions of dollars in pre-orders and retailer commitments.
Well, massive success right out of the gate.
Right. And you look at their income statement at the end of the quarter, and it is a masterpiece. The revenue line is skyrocketing. The margins are super healthy. The bottom line net income is massively positive.
So they look incredibly profitable on paper.
Exactly. They are incredibly profitable. And then, on a random Tuesday, the CEO walks into the office and files for Chapter 11 bankruptcy.
Wow.
The doors close, the employees are sent home, the company is just dead.
Yeah. And, it happens far more often than anyone outside of corporate finance actually realizes. It's kind of the ultimate paradox of business.
But how does that even happen? How does a company with millions in profit just disappear overnight? I mean, they had the demand, they had the margins.
Because, well, you cannot pay your employees with profit.
Right.
You can't pay your suppliers with net income. You can only pay them with hard cash.
Yeah, the bank doesn't take spreadsheets.
Exactly.
Yeah.
That company died because while their income statement showed millions in profit, all of that quote-unquote wealth was trapped.
Trapped where?
It was trapped in raw materials sitting in a warehouse, or trapped in half-finished products on an assembly line.
Oh, I see.
And it was trapped in invoices that their retailers just hadn't paid yet.
Yeah.
So when payroll hit on Friday, the actual bank account was completely empty.
Wow. So profitability just does not equal survival. Not in the short term, anyway.
No, not at all.
And that disconnect, that gap between the theoretical profit on a spreadsheet and the actual physical cash needed to keep the lights on, that is what we are mastering today.
It's the most critical concept.
It really is. So welcome to the deep dive. If you are preparing for your MBA exams or getting ready to step into a corporate strategy role, understanding this mechanism is just non-negotiable.
Absolutely.
We are dissecting Unit 14 from our corporate finance text. We're talking about the mechanics of working capital management. Okay, let's unpack this. We're going to map exactly how a dollar flows through a business.
Right, where it gets stuck, and how the world's most powerful companies manipulate this flow to literally fund their own growth.
Yeah. We are stripping away the illusion of the income statement here.
Exactly. Because, a balance sheet gives you a snapshot, right? And an income statement gives you a historical record. But working capital is the actual lifeblood of the operation.
The thing keeping it breathing today.
Yes. It is the bridge between the short-term assets you hold and the short-term liabilities you owe.
Okay, so let's break that down.
Well, think of it like this.
Yeah.
You can own the most state-of-the-art billion-dollar manufacturing facility on Earth. Those are your fixed assets.
Right.
But if you lack the working capital to purchase the aluminum and the microchips to actually feed into those machines.
Or just the cash to pay the technicians to run them.
Exactly. If you don't have that, then that billion-dollar facility is nothing more than a giant, expensive monument to poor financial management.
Basically a giant paperweight.
A paperweight that will eventually drag the entire enterprise to the bottom of the ocean.
Okay, so to prevent that, we have to understand the specific vocabulary and the specific metrics that financial managers use to keep that blood pumping. Let's look at the balance sheet.
Good place to start.
It's fundamentally divided by time, right? The duration of what you own and the duration of what you owe.
Time is the absolutely critical variable here. So on the asset side, you have fixed assets, land, heavy machinery, buildings.
The big stuff.
The big stuff. These are capital investments retained in the business to generate profit over a long horizon. We're talking 5, 10, 20 years. They're not for sale.
Right.
Then you have current assets, and these are highly liquid. By definition, a current asset is something you reasonably expect to convert into actual cash within a single accounting period.
Which is typically just 1 year, right?
Exactly, 1 year.
So we're talking about cash itself, obviously, but also short-term investments and your inventories.
Yes, and keep in mind, inventory isn't just like boxes on a retail shelf.
Right, it's raw materials waiting to be used.
Yeah, or it's work in progress, currently moving down the assembly line. And it's finished goods waiting for a buyer.
And it also includes accounts receivable, right?
Yes, absolutely. Okay. The money your customers legally owe you for products you've already delivered, but, they just haven't paid for yet.
Okay, so that's the asset side. What about the liabilities side?
Mirroring that on the liability side, you have the exact same time division. So long-term liabilities are your 10-year corporate bonds or your equity capital.
Things you don't have to worry about right this second.
Exactly. But current liabilities, those are the immediate threats. I mean, these are the obligations you absolutely must settle within the next 12 months.
Like the supplier who sold you the aluminum wants to be paid in 30 days.
Right. Or the bank expects its monthly overdraft fee. Your employees expect their wages every 2 weeks. Those are all current liabilities.
And when you look at those short-term assets and short-term liabilities together, you are looking at the arena of working capital.
That's the arena.
But in corporate finance, we don't just look at it as one big amorphous blob, do we? The text says there are two distinct lenses through which we view this.
Yeah. Gross working capital and net working capital.
Sure.
And these two concepts serve completely different strategic purposes for a manager.
Okay, let's start with gross.
So gross working capital is purely quantitative. It is the absolute total amount of funds invested in all of your current assets combined.
Just a raw number.
Just a raw, massive number. I mean, in a heavily industrial manufacturing firm, the total investment in raw materials, cash, and receivables can easily make up like 50 to 60% of the company's total assets.
Wow, that's huge. So the gross concept is literally just the total pool of short-term resources.
Yes.
But then we have net working capital. And this is where you take those total current assets and you subtract the total current liabilities.
Right. It's the difference between what you have coming in soon and what you have to pay out soon.
And the text calls this a qualitative metric. Why qualitative?
It is qualitative because it reveals the structural integrity of your financing.
Okay, how so?
Well, if your net working capital is positive, meaning your short-term assets are strictly larger than your short-term debts, it indicates a margin of safety.
It means you can pay all your immediate bills and still have assets left over to operate the business.
Exactly. But mathematically, think about this. If short-term assets exceed short-term liabilities, where did the money come from to buy those excess assets?
Wait, let me make sure I'm visualizing this correctly.
Sure.
If I have $1 million in inventory and receivables, but I only owe my suppliers $500,000,
Right.
I still had to pay for that other $500,000 of inventory somehow.
You did.
Are you saying that excess $500,000 must have come from a long-term bank loan or from the shareholders' equity?
That is exactly the mechanism.
Yeah.
A positive net working capital means long-term, stable funds are being used to support your daily operations.
Oh, wow.
And that provides a tremendous qualitative cushion. Now, consider who cares about which metric.
Okay.
A small business owner, right? Like a sole proprietor running a local logistics company. They are deeply obsessed with net working capital.
Because their entire mindset is just survival.
Exactly. It's all, can I pay my drivers this week given what my clients owe me?
But a CFO at a massive multinational corporation views it differently. They lean way more heavily on the gross working capital concepts.
Because for a Fortune 500 CFO, survival isn't the daily question. I mean, efficiency is.
Right.
The financial manager of a global enterprise is responsible for optimizing billions of dollars tied up in global supply chains.
Mm-hmm.
They have to manage that total investment pool.
So if they can figure out how to operate with, say, 10% less gross working capital, meaning holding 10% less inventory globally without disrupting sales,
Yes.
they free up hundreds of millions of dollars to invest in R&D or pay out as dividends.
Precisely. The gross concept is all about operational optimization.
Which brings us to how we actually measure that safety and optimization. The classic liquidity metric.
Their ratios.
Right, the ratios. If you are an MBA student analyzing a case study, you are definitely going to be calculating the current ratio.
It's the baseline.
And that's simply current assets divided by current liabilities. The general benchmark you see tossed around is 2 to 1. You want twice as many short-term assets as short-term debts.
Right. And for a more stringent stress test, you use the acid test ratio, which is also known as the quick ratio.
How is it different?
Here, you take your current assets, but you strip out inventory and any other assets that aren't immediately liquid.
Because inventory can be hard to sell in a panic.
Exactly. You only look at cash, marketable securities, and pristine receivables, and divide that by current liabilities. The standard target there is just 1 to 1.
Okay, let's hold on that 2 to 1 standard for the current ratio for a second.
Sure.
Because if a 2 to 1 ratio means I'm healthy and safe, Wouldn't a 5-to-1 ratio mean I'm an absolute fortress?
Well,
I mean, if I'm advising a company and I see they have 5 times as many current assets as liabilities, my instinct is to applaud the CFO for being incredibly prudent.
yeah.
Why is 2-to-1 the gold standard? Why not hoard as much cash and inventory as humanly possible to ensure we never, ever face that random bankruptcy Tuesday we talked about?
It is the most common trap for conservative managers.
Oh,
A 5-to-1 ratio is a fortress? Yes. You are completely insulated from short-term shocks.
sounds great to me.
But a fortress is really expensive to build and maintain, and it doesn't generate new wealth.
Oh, I see.
Think about what a 5-to-1 ratio actually represents in the real world. It means you have mountains of cash sitting in bank accounts earning minimal interest. It means your warehouses are stuffed to the ceiling with inventory that is just sitting there gathering dust.
It's capital that just isn't working.
It is lazy capital. Every dollar you have sitting in a warehouse as excess inventory is a dollar you did not use to launch a new product line
Or hire top engineering talent.
or expand into a new geographic market.
Exactly. Financial management is a ruthless, unrelenting tug of war between liquidity and profitability.
Liquidity versus profitability.
Yes, liquidity is keeping enough cash to survive today. Profitability is investing that cash into risky, long-term ventures to grow tomorrow.
So if you hoard working capital, your liquidity is perfect, but your profitability, specifically your return on assets, will just plummet.
It will. And your shareholders will replace you with someone who actually knows how to put their money to work.
Ouch. Okay, so this tug of war introduces another way we have to categorize this capital. We can't just look at it as a static pool.
No, we can't.
We have to look at it over time, which brings us to permanent working capital versus temporary working capital. And this distinction is really crucial for figuring out how to actually finance the business, which we'll tackle deeply later on. But conceptually, permanent working capital is the absolute minimum baseline of current assets you need to just keep the doors open.
Think of it like a commercial building's plumbing system.
Okay, I like this.
You have to fill the pipes with thousands of gallons of water just to pressurize the system so that when someone turns on a faucet on the top floor, water actually comes out.
Right.
You can never drain that baseline water, or the whole system fails. In a business, you always need a minimum baseline of cash in the register to make change.
Yes.
You always need a minimum baseline of raw materials on the shelves so the factory doesn't halt. You always need a baseline of finished goods in the showroom so customers actually have something to buy.
That is permanently locked into the system.
Exactly.
That is a perfect visualization.
Yeah.
Even though the actual atoms of the inventory are constantly changing, like you sell a product and build a new one, the financial value permanently resides in that category.
It never goes to zero.
Never. It grows slowly as a steady, upward sloping line as the company expands over time.
And then you have temporary working capital. If the permanent capital is the water pressurizing the pipes, the temporary capital is the massive surge of extra water you need when you turn on the emergency fire sprinklers.
Or the outdoor landscaping sprinklers in the dead of summer. It's highly variable.
Right. It fluctuates wildly based on seasonal demands or, special exigencies.
Yeah. Like a retail company stocking up massive amounts of inventory in October in preparation for the holiday shopping season, they're deploying temporary working capital.
And then by January, that inventory is sold, the cash is collected, and that specific pool of working capital dissipates back down to the permanent baseline.
Exactly.
So a manager has to constantly adjust this fluctuating pool of temporary capital while maintaining the permanent baseline, all while walking the tightrope between liquidity and profitability.
It's a tough job.
What happens when they lose their balance? Let's spend some time exploring the Goldilocks zone of financial management.
Okay, the Goldilocks zone.
Yeah. What happens when a company runs too hot with excessive working capital or too cold with inadequate working capital?
Let's start with running too hot. The dangers of excessive working capital.
Yes.
Imagine a major apparel retailer. The CFO decides to play it entirely safe and approves a massive accumulation of inventory to ensure they never, ever face a stock out.
They buy an ocean of working capital.
Right. On paper, their current ratio looks amazing, but what's the operational reality?
Well, the operational reality is degradation, right?
Yes. First, unnecessary accumulation of inventories leads directly to physical waste. Warehouses get disorganized,
Oh yeah, stuff gets lost.
theft or shrinkage skyrockets because there's so much product no one can track it accurately.
But in apparel or technology or seasonal goods, the ultimate killer is obsolescence, right?
The absolute killer. If you are sitting on thousands of winter coats and spring arrives or, a new fashion trend hits, that inventory loses 80% of its value overnight.
You took hard, versatile cash and turned it into rigid, depreciating fabric.
You essentially set the money on fire.
But it's not just the inventory, right? Excess capital infects the entire culture of the business.
It really does.
If you have a massive cushion of cash, your credit policy usually gets incredibly lazy.
That is the second major danger, defective credit policies. If a sales team knows the company has millions in the bank, they will offer clients absurdly generous payment terms just to close a deal.
Like, don't worry, take 120 days to pay us.
Exactly. And when you stretch your collection period that far, the incidence of bad debts clients who go bankrupt or simply refuse to pay it increases exponentially.
Because the longer a debt sits out there, the less likely it is to ever be collected.
Absolutely.
Yeah.
And fundamentally, it breeds managerial complacency.
How so?
Well, if you never have to worry about making payroll, you stop scrutinizing expenses. You stop negotiating hard with suppliers. Efficiency dies in the presence of unconstrained resources.
Wow. Efficiency dies in the presence of unconstrained resources.
That's a great line.
It's true. The return on overall investment slumps because idle funds yield no return. Okay, so hoarding cash and inventory breeds laziness, waste, and poor returns. So let's swing the pendulum to the absolute opposite extreme.
Okay, running cold.
Yeah. Let's look at the nightmare of inadequate working capital. This is the hyper-aggressive manager who wants to run the company incredibly lean.
Right.
They want to maximize profitability, so they keep zero excess cash and rely entirely on just-in-time inventory.
And this is the death spiral.
Yeah.
It usually starts with the stagnation of growth.
What does that look like?
Let's say our lean apparel company suddenly goes viral, demand explodes on TikTok or whatever.
Go.
They want to open 3 new flagship stores and triple their production. But because they run so lean, they literally do not have the cash on hand to sign the commercial leases or buy the massive initial batches of fabric.
Oh, man.
High return, incredibly profitable projects must be abandoned simply due to the non-availability of funds.
And while they're missing out on growth, the day-to-day operations start to fracture too, right?
Exactly. You begin missing day-to-day commitments. You delay paying the textile supplier. You delay the logistics company.
And then what?
Operating inefficiencies compound rapidly because top management stops focusing on strategic growth and spends 80% of their day putting out immediate financial fires.
Just negotiating extensions and pleading with vendors.
Exactly.
Yeah.
And going back to the fixed assets, say they signed a lease for a beautiful, expensive flagship store in a prime location, that's a massive fixed cost.
Right.
But because they don't have the working capital to fully stock the shelves, customers walk into a half-empty store.
So the fixed asset is being criminally underutilized, which destroys its rate of return.
Furthermore, they miss out on structural advantages. Suppliers often offer attractive cash discounts for early payment.
Like, pay us in 10 days instead of 30, and we'll knock 2% off the invoice.
Yeah, and that 2% translates to a massive annualized return. But a firm running with inadequate working capital can never capture those discounts because they never have cash early.
They're always scraping by.
Always. Ultimately, what kills them is the loss of reputation.
Yeah, that makes sense. A customer who comes to a store and finds empty shelves goes to a competitor and just never comes back.
And a supplier who gets a delayed payment puts a company on strict cash-on-delivery terms, which instantly tightens the financial news even further.
Oh, that's brutal.
The bank notices the delayed payments and raises the interest rate on their credit lines. It is a cascading failure of trust.
So the mandate for the financial manager is clear. You must find the exact center of gravity. You must hold exactly enough working capital to ensure smooth operations and vendor trust, but not $1 more.
Right, so that every other dollar is relentlessly driving profitability.
But to find that exact center, we have to move beyond static ratios and understand the velocity of money. We have to map the cycles.
Ah, the cycles. This is where we track the heartbeat of the business.
Yeah. The entire need for working capital exists for one simple reason, right? There is a time lag.
A gap in time.
Exactly. A gap between the moment you pay your suppliers for raw materials and the moment your customer finally hands you cash for the finished product. That gap is the operating cycle.
And measuring that gap requires breaking it down into distinct, measurable phases.
Okay, let's walk through them.
Phase 1 is the conversion of cash into inventory. You spend money to acquire raw materials, and you pay the labor and power costs to start processing them.
Got it. Phase 2 is the conversion of that inventory into receivables.
Right.
So the raw material becomes work in progress on the factory floor, then it becomes a finished good sitting in the warehouse. Finally, you sell it.
But you usually sell it on credit, especially in B2B transactions. So the inventory turns into an account receivable, a promise to pay.
Okay, and phase 3?
Phase 3 is the final conversion of those receivables back into cash. You collect the invoice, the cycle is complete, and ideally, the cash you collect is greater than the cash you initially spent.
And that difference is your profit. To quantify this heartbeat, we use specific conversion periods. If you were taking notes for an exam, these are the components you absolutely must master.
Write these down.
First is the inventory conversion period, or ICP. Simply put, how many days does it take to turn a pile of raw materials into a sold product?
Right. And for a manufacturing firm, this is actually 3 mini cycles combined.
Which are?
The raw material conversion period, which is how long it sits in the storeroom. Then the work in progress conversion period, which is how long it takes to actually build the thing.
And the finished goods conversion period, which is how long the finished product waits in a warehouse for a buyer.
Exactly. Add those together and you have your total inventory conversion period.
Okay. Next, we have the debtors conversion period, the DCP. Once the sale is made, how many days does it take your sales and finance teams to actually extract the cash from the customer?
Yep. And finally, on the other side of the ledger, we have the days payable, heavily referred to as the creditor's deferral period, or CDP.
This is the leverage you hold.
Right. How many days can you delay paying your own suppliers without damaging the relationship?
Okay, so these 3 components give us the master formulas of corporate finance.
The big ones.
The operating cycle, or OC, is the total time from the start of production to the collection of cash. Mathematically, it is the inventory conversion period plus the debtors conversion period.
But the operating cycle isn't the whole story.
Why not?
Because it ignores the fact that you haven't actually paid your suppliers on day one. You've deferred payment.
Ah, right.
This brings us to the ultimate metric, the cash conversion cycle, or simply the cash cycle.
And what's the formula for that?
The cash cycle equals the operating cycle minus the creditor's deferral period.
Okay, let's ground this in a practical proxy. Let's look at a hypothetical mid-sized manufacturer. They buy materials, build a product, and sell it.
Okay.
After running their balance sheet numbers, we find their inventory conversion period is roughly 94 days. It takes them 94 days from the moment materials arrive to the moment the finished product is sold.
All right. We check their receivables, and their debtor's conversion period is 44 days. It takes them a month and a half to get paid after the sale.
So their operating cycle is 94 plus 44, which equals 138 days. From the start of the physical process to the end of the financial collection, 138 days pass.
But they have negotiated decent terms with their suppliers. Their creditor's deferral period is 43 days. They get to hold on to their cash for 43 days after the materials arrive.
Okay, so we calculate the final cash conversion cycle, the 138-day operating cycle minus the 43-day deferral period leaves us with 95 days.
95 days.
I like to visualize the cash cycle as tracking how long a single dollar bill has to hold its breath underwater before it comes back up to the surface.
That's a great way to look at it.
For this company, the day they finally wire the cash to their supplier, that dollar dives underwater. It stays submerged while the product is built, while it sits in the warehouse, while it is sold, and while they wait for the customer to pay.
It is underwater for 95 days before it surfaces as collected revenue.
And during those 95 days, that dollar is utterly useless to you.
Completely useless. You cannot use it to pay rent. You cannot use it to pay executives. The overarching prime directive of working capital management is to minimize the time that dollar holds its breath.
You must ruthlessly compress the cash conversion cycle.
Yes, because the faster inventory moves, the less chance it has to become obsolete. The faster you collect from customers, the less chance they go bankrupt before paying you.
But let me push back on something that often trips people up.
Sure.
The literature always emphasizes that a shorter cash cycle drastically reduces a company's reliance on external financing. But why? If my company spends $1 million a year on raw materials, I still have to spend $1 million whether my cash cycle is 90 days or 30 days. The business costs the same to run over the year. Why does a shorter cycle save me from needing a bank loan?
It is a brilliant question, and it cuts to the core of the time value of money and opportunity cost. Think of it not as the total annual cost, but as the amount of capital permanently trapped in the system at any given moment. Let's use easy proxy numbers.
Well,
Suppose it costs you $1,000 a day to run your business, materials, labor, everything.
got it.
If your cash cycle is 95 days, you have to fund 95 days of operations before the first dollar of revenue cycles back to you. That means you need a working capital pool of $95,000 permanently locked in the business just to keep it afloat.
And most companies don't just have $95,000 in cash lying around, so they use a bank overdraft or a short-term revolving credit facility to fund it.
Precisely. You are borrowing that $95,000 from a bank, and you are paying interest on it every single day of the year. It acts as a massive anchor on your net margins.
Okay, I see.
Now imagine a ruthless, hyper-efficient manager comes in. They negotiate harder with suppliers to extend payment terms. They threaten to cut off customers who don't pay in 15 days. They optimize the factory floor. They compress the cash cycle from 95 days down to 30 days.
Okay, so now they only need to fund 30 days of operations at $1,000 a day. They only need a working capital pool of $30,000.
Yes. They have structurally liberated $65,000 in pure cash.
Oh.
They can immediately use that $65,000 to pay down their bank debt. Not only have they freed up capital for growth, but they have permanently eliminated the daily interest expense on that $65,000.
And that interest savings drops directly, dollar for dollar, to the bottom line profit.
Exactly. You haven't changed the cost of the raw materials, but you have fundamentally changed who is financing your business. You are forcing the velocity of your own operations to finance your growth, rather than paying a bank a premium to do it for you.
That is the power of the cycle. You are optimizing time, and time is literally money. Now, I want to pull a concept forward here because it is the ultimate evolution of this mechanism.
Oh, I know where you're going.
We talked about compressing the cycle to 30 days, but what happens if you compress it so hard that the formula breaks? What if a company becomes so massive, an apex predator in the market, that they can warp the timeline entirely?
You are talking about the holy grail of corporate finance, the negative cash conversion cycle.
Let's walk through the math of a negative cycle. We know the formula. Cash cycle equals the operating cycle minus the creditor deferral period.
Right.
What happens if a titan like Amazon or Apple dictates terms so aggressive that their deferral period is longer than their entire operating cycle?
It is a fascinating phenomenon. Let's look at a hyper-efficient retailer. Because of their immense logistical prowess, their inventory flies off the shelves. From the moment a product arrives at their distribution center, it is shipped to a customer and paid for via credit card within 30 days.
So their operating cycle is lightning fast, 30 days.
But because they are a massive retailer, they have absolute leverage over the companies manufacturing the goods. If a manufacturer wants their product on this Titan's platform, they have to accept the Titan's terms.
And the titan says, we aren't paying you for 90 days.
So, run the formula. Operating cycle of 30 days minus a creditor deferral period of 90 days. The cash conversion cycle is negative 60 days.
Negative 60 days. The dollar doesn't hold its breath underwater. It actually arrives 60 days before it's even supposed to exist.
Let's trace the physical reality of that negative 60 days. The Titan receives the product on day 1. They sell it to a consumer and collect the cash on day 30. But they don't have to pay the manufacturer until day 90.
That means for 60 whole days, the Titan is holding the customer's cash without having paid a single dime for the product.
They have 60 days to invest that cash, earn interest on it, or use it to build new warehouses.
Exactly. They are not using a bank to finance their daily operations. They are not even using their own equity.
Nope. They are ruthlessly using their own suppliers as an interest-free credit facility. The suppliers are literally funding the Titan's global expansion.
That's wild.
When an MBA student looks at the balance sheet of a modern retail or tech giant and sees a negative cash conversion cycle, they aren't just looking at accounting, they're looking at raw operational dominance.
That fundamentally shifts how I look at market power. But, not every company can be a global titan. For the vast majority of businesses, a negative cycle is impossible.
Really?
So what makes these cycles stretch or shrink in the normal world? There is no universally acceptable rule for how much working capital you need because every business is shaped differently.
We need to examine the determinants of working capital.
Right. Let's get into those determinants.
The primary determinant is simply the nature of the business. You have to understand the structural realities of the industry before you can judge its balance sheet. Let's compare a pure software as a service or SaaS company to a heavy industrial machinery manufacturer.
Okay, a SaaS company sells digital subscriptions. Their inventory is virtually zero.
Right.
They don't have warehouses full of software waiting to be shipped. Their product is delivered instantly, and usually customers pay by credit card up front for the month or the year.
So their working capital needs are incredibly low relative to their revenue.
Contrast that with a company building commercial bulldozers.
Entirely different beast. They have to purchase massive quantities of steel and hydraulics. The production cycle, the time it takes to actually weld and assemble the machine, might take months.
And once it's finished, a commercial buyer isn't paying with a credit card up front. They demand extensive financing and credit terms.
Exactly. The industrial firm has mountains of cash trapped in raw materials, trapped on the assembly line, and trapped in long-term receivables. Their working capital requirements are inherently massive.
So, nature of business, size, and scale are obvious. But let's look at production policy. This is where strategic choices dictate capital needs.
This is a fun one.
Let's say you manufacture winter snowboards. Your demand is violently seasonal. 80% of your sales happen between October and January. As a manager, you have a choice.
Do you keep your manufacturing plant running at a steady, even pace all year round?
If you choose steady production, you will accumulate massive mountains of finished snowboards during the spring and summer when nobody is buying them.
And that requires a huge amount of working capital to pay for the materials and labor, only to have the cash trapped in a warehouse for 6 months.
Or do you shut down the factory in the spring and frantically ramp up production in late summer?
If you do that, your inventory working capital needs are much lower, but you face the chaos of hiring temporary labor and the risk of production bottlenecks right before your prime selling season.
Every operational choice changes the working capital math.
It really does. Another fascinating determinant is the availability of raw materials. We often assume supply chains are smooth and continuous.
But what if your primary raw material is an agricultural commodity that is only harvested once a year?
Then you are forced to buy 12 months worth of supply in a single 3-week window. You have to deploy a massive amount of working capital all at once to secure your raw material, completely freezing your funds and inventory for the rest of the year.
Wow. We also have macroeconomic factors, right?
Oh, absolutely. During an economic boom, companies are expanding, consumer demand is high, and inflation often drives up the price of raw materials.
So you need significantly more working capital just to purchase the same physical volume of goods at higher prices while simultaneously scrambling to build more inventory to meet surging demand.
But out of all the determinants, there is one critical, counterintuitive paradox that every student must internalize.
What is it?
It is the paradox of the growth rate. Instinctively, people think that a fast-growing, highly successful company generates a lot of cash and therefore has an easy time managing working capital.
Yeah, that's what you'd assume.
The reality is the exact opposite.
This goes back to our bankruptcy story at the beginning.
Yes, the working capital requirement of a fast-growing enterprise increases exponentially. But the need for the cash does not follow the growth in sales. The need precedes the sales.
Hold on, let me play devil's advocate here.
Go for it.
If my sales are doubling every quarter, I have twice as much revenue coming in. Shouldn't that surplus revenue fund my next quarter?
It would if time didn't exist. But remember the cycle. Before you can achieve those doubled sales in Q2, you first have to buy twice as much raw material in Q1.
Oh, right.
You have to hire twice as many factory workers. You have to lease a larger warehouse. You have to spend millions of dollars in cash today to build the inventory that will generate revenue 3 months from now.
Growth is a massive, relentless consumer of cash.
This is why highly successful, fast-growing startups routinely go bankrupt. They stare at the skyrocketing sales curve and celebrate. But they fail to secure the advanced working capital required to build the product that fulfills that curve.
Growth without capital planning is fatal.
It's the #1 killer of startups.
That is a chilling reality check. You literally grow yourself to death. Now, let's pivot to something entirely internal. Dividend policy.
Okay.
When I think of daily operational cash, I don't immediately think of the boardroom voting on shareholder dividends.
You should, because they pull from the exact same pool of resources. A company's internal retained earnings, the profit it keeps rather than distributes, is the safest, cheapest source of working capital available.
So if a company has a policy of aggressively paying out steady, high cash dividends to keep its stock price inflated,
it is systematically draining its own lifeblood. It bleeds its internal cash reserves, forcing the operational managers to go to banks and take on expensive, risky short-term debt just to meet payroll,
Mhm.
a high dividend policy directly strangles working capital.
Okay, we understand the variables. We know the cycles, we know the dangers, we know the determinants. But understanding the theory isn't enough.
Theory only gets you so far.
If you are the financial manager of a manufacturing plant, your CEO isn't going to accept a theoretical essay on the nature of business and economic booms.
No, they want numbers.
They are going to look at you and say, we plan to produce 100,000 units next year. Give me a hard number. Exactly how many millions of dollars do we need in the bank on January 1st to ensure we don't go bankrupt?
Yep.
How do we actually estimate the hard numbers?
This requires building a financial model. The literature provides several approaches. The simplest is the conservative approach, which essentially just mandates maintaining that rigid 2-to-1 ratio of current assets to current liabilities, regardless of the operational realities.
But we've already debunked the 2-to-1 ratio as a blunt instrument. It doesn't tell you if your inventory is actually sellable or if your receivables will ever actually be paid.
Precisely. To get a hard operational number, we have to use the components approach, also known as the current assets holding period method.
How does that work?
This is where you dissect the business down to its atoms. You estimate the working capital requirement by calculating the specific average holding period of every single component: raw materials, work in progress, finished goods, debtors, and creditors, and you translate that time into proportional cost.
Let's build a conceptual model so the listeners can visualize the mechanics of this math without getting bogged down in an audiobook of equations.
Okay, I like that.
Imagine you are forecasting the capital needed to run a factory for the upcoming 52-week year.
You start on the asset side. First, raw materials. You look at your supply chain data and realize that, on average, raw materials sit in your warehouse for 4 weeks before they are moved to the factory floor.
4 weeks out of a 52-week year, that's roughly 8% of the year.
Exactly. Conceptually, that means roughly 8% of your entire annual budget for raw materials is permanently trapped in the warehouse at any given second.
So if you plan to spend $10 million on steel this year, you need roughly $800,000 in working capital solely dedicated to funding that static pile of steel.
Spot on. Next is the work in progress, the WIP. This is the trickiest part to conceptualize.
Yeah, because a product on the assembly line isn't raw steel anymore, but it isn't a finished, sellable car either. It's halfway done. How do you value a half-finished product for a balance sheet?
The standard accounting convention for estimating WIP requires looking at the input timing. The raw material is usually committed 100% at the very beginning of the process.
The steel is pulled from the warehouse on day one.
Exactly. But the labor and the factory overhead, the electricity running the machines, is applied gradually over the production cycle.
Right.
Therefore, to value the WIP, you take the full cost of the raw materials involved, but you only apply 50% of the labor and overhead costs, assuming the average item on the line is halfway finished.
Oh, that's clever.
Yeah, you calculate how many weeks a product spends on the line, and you apply that proportion to those adjusted costs.
So we have the cash trapped in raw storage and the cash trapped on the assembly line. Next, finished goods.
The cars roll off the line and sit in a holding lot, waiting for a dealership to buy them.
If historical data says cars sit in the lot for 4 weeks, you again take roughly 8% of your total annual cost of production materials, labor, and overhead combined. And that is the capital permanently frozen in the holding lot.
And then we reach the final asset, the debtors. The money owed to us by the dealerships. Let's say we give the dealerships 2 months, 8 weeks to pay us for the cars.
8 weeks is roughly 15% of the year. So 15% of our annual sales volume is out there in the ether, waiting to be collected.
But here is the massive, critical trap that ruins financial models and destroys MBA students on exams. Listen very carefully to this principle.
Warning bells ringing.
When you are calculating the working capital tied up in your debtors, your accounts receivable, you do not base the calculation on the final selling price of the product. You base it strictly on your cost to produce it.
This is a fundamental conceptual hurdle. Let's say it costs you $80 to build the car and you sell it for $100.
Right.
When the dealership owes you money, they owe you $100. Your accounts receivable ledger says $100. Why, when estimating working capital, do we only calculate based on the $80?
Because working capital is about funding operations. That $20 difference is your profit margin. It represents future wealth. But right now, today, you haven't actually spent that $20.
Ah.
You only spent the $80 in raw materials and labor. You only have to finance the money that actually left your bank account.
If you calculate your working capital needs based on the $100 selling price, you are artificially inflating your capital requirements by pretending you need to finance your own unearned profit.
Perfectly stated. You only finance your costs. So you add up the capital trapped in raw materials, the capital trapped in work in progress, the capital trapped in finished goods, the capital trapped in debtors at cost, and finally, a baseline reserve of pure cash you want in the bank for emergencies.
And that sum is your total current assets requirement.
But we aren't done. We have to calculate the other side of the ledger. The current liabilities. This is the leverage we hold, the money we are allowed to delay paying.
Okay, we calculate the creditors. If our steel supplier gives us 4 weeks to pay them, that means roughly 8% of our annual raw material budget is being financed by the supplier.
Right. We calculate the delay in paying wages. If we pay workers every 2 weeks, we are essentially holding 2 weeks of their labor costs in our bank account.
You sum up those delayed payments, the supplier credit, the delayed wages, the delayed utility bills, that is your total current liabilities.
Finally, you take your massive total current assets requirement and you subtract those current liabilities. The resulting number is your exact net working capital requirement.
It is the precise dollar amount of long-term funding you must inject into the system to ensure it runs flawlessly for the next 12 months.
Boom. You've built your model.
Okay, so we've built the model, we've mapped the holding periods, dodged the profit margin trap, and done the math. Let's say the final number spits out. We need exactly $5 million in net working capital to fund the factory next year.
Okay.
Now we arrive at the final strategic crossroads. Whose money are we going to use? How do we finance that $5 million?
Before a CFO chooses a specific financial instrument, they have to align with the core principles of working capital finance. These principles govern the structural safety of the firm.
What's the first one?
First is the principle of risk variation. There is an inescapable inverse relationship between risk and rate of return.
You mean here?
If you maintain a massive conservative buffer of working capital, your risk of insolvency drops to near zero. But because you're using expensive long-term capital to fund idle assets, your rate of return on that money plummets. You are safe, but unprofitable.
Got it. And the second principle?
Second is the principle of equity position. You cannot infinitely leverage a company. Every dollar of debt you take on to fund working capital must be adequately justified by the firm's underlying equity base.
A bank won't lend you $5 million for inventory if the owners only have $10,000 of equity in the business.
Exactly. They need to see you have skin in the game.
Third is the principle of cost of capital. Different piles of money cost different amounts. A 10-year term loan from a massive institutional bank is generally safer because they can't suddenly demand the money back tomorrow.
Right, but that safety is expensive. You pay a higher interest rate over a decade.
On the other hand, short-term commercial paper or a 30-day overdraft is incredibly cheap in terms of interest rate.
But it is highly risky because the bank can freeze the credit line overnight if the market panics.
Which perfectly sets up the final rule, the principle of maturity of payments. The golden rule of corporate stability is that you should attempt to match the maturity of your debt to the maturity of the asset it is financing.
Yes. You should not use a 10-year corporate bond to finance a 3-month seasonal spike in winter coats.
To put these principles into action, companies adopt one of 3 broad financing approaches. To grasp these, we need to bring back our visualization from earlier. Let's paint the picture again.
Okay, close your eyes and picture this graph.
Imagine a graph tracking your company's capital needs over 5 years. At the bottom, you have a solid, upward-sloping diagonal line. Those are your fixed assets, factories, and machines growing steadily as the company expands.
Right.
Right above that, you have a parallel, upward-sloping line. The space between the first line and the second line is your permanent current assets. This is the minimum baseline water pressure in the plumbing system, the required baseline of inventory and cash that must always exist.
Got it.
And finally, riding on top of that second line, you have a wild, wavy, fluctuating curve going up and down with the seasons. Those are your temporary current assets, the massive inventory buildup for the holidays, followed by the liquidation in January.
Okay, I see it.
The approach you choose simply determines where you draw a flat horizontal line across this graph. Everything below your line is funded by safe, expensive, long-term debt or equity. Everything above your line is funded by risky, cheap, short-term debt.
Let's look at the first strategy, the matching or hedging approach. This is the orthodox, theoretically perfect execution of the maturity principle.
Where do they draw the line?
In this approach, you draw the debt line perfectly between the permanent assets and the temporary wave. You use long-term, stable funds, like a 10-year bond or equity, to finance all of your fixed assets and all of your permanent current assets.
You accept that the baseline plumbing will always be full of water, so you buy that water with permanent money.
Exactly. You only use short-term financing, like a 90-day bank loan, to finance the wavy line, the purely temporary seasonal peaks. Once the season ends and the inventory is sold, you pay off the short-term loan. The maturity of the debt perfectly matches the lifespan of the need.
It is clean and logical. But then we have the conservative approach. Here, a risk-averse management team draws the debt line much higher up, slicing right through the middle or even the top of the temporary wavy line.
In the conservative approach, the firm uses long-term, highly stable funds to finance the fixed assets, the permanent current assets, and a significant portion of its temporary fluctuating needs. They are using 10-year money to fund 3-month problems.
But wait, if they use long-term money to fund a seasonal spike in October, what happens in February when the inventory is gone, but they still have this massive tool of long-term cash sitting around?
They park it. When it's the off-season and they don't need those temporary assets, they take the idle long-term funds and invest them in highly liquid, low-yield tradable securities just to earn a tiny bit of interest. This approach is virtually bulletproof against bankruptcy. Even in a severe credit crisis, they survive because their funding is locked in for years. But it aggressively violates the cost of capital principle.
Because long-term funds demand high returns. By using expensive equity or long-term debt to fund seasonal fluctuations, they severely drag down the overall profitability of the firm.
Exactly.
Which leads us to the final and most dramatic strategy, the aggressive approach. Here, a management team draws the line much lower down, sometimes dipping below the permanent working capital line.
Oh, yeah. The aggressive firm uses cheap, short-term financing to fund all of its temporary seasonal assets.
Yeah.
But they go further. They use rolling short-term debt to fund a large portion of their permanent current assets.
Wow.
The most extreme, hyper-aggressive firms might even use short-term commercial paper to finance their fixed assets. They are buying factories with 30-day loans, constantly rolling them over month after month.
Let me push back hard on this. Why would any rational board of directors ever allow a CEO to choose the aggressive approach? It sounds like practically begging for insolvency.
It does sound crazy.
If a macroeconomic shock hits, say, a global pandemic or a sudden spike in interest rates, and the short-term credit markets freeze, the bank refuses to roll over that 30-day loan. If you were using that loan to fund your permanent baseline inventory, your business collapses overnight. You literally cannot open the doors the next morning.
It is an incredible risk. It is picking up pennies in front of a steamroller. But managers do it because of the relentless pressure of Wall Street and the allure of cost of capital arbitrage.
Explain that.
Short-term debt is almost always cheaper than long-term debt. A 30-day commercial paper rate might be 2%, while a 10-year bond is 6%.
Okay, I see.
By aggressively replacing expensive long-term capital with incredibly cheap short-term debt, a manager drastically lowers the firm's overall weighted average cost of capital. That massive reduction in interest expense drops straight to the bottom line. It artificially skyrockets their return on equity.
The quarterly earnings look spectacular. The stock price surges. The executive team gets massive bonuses for their brilliant efficiency.
Exactly. It is highly, highly lucrative, right up until the exact moment the credit markets freeze. And then, as you said, the steamroller hits and they collapse overnight. It is the classic agency problem in corporate finance managers chasing short-term metrics at the risk of long-term survival.
So, assuming a company chooses a rational path, where are they actually getting this money? What are the specific instruments?
Well, for the permanent foundation, they rely on long-term sources. Issuing shares equity is the most stable, as it never has to be repaid, though it dilutes ownership. Issuing corporate debentures or bonds.
Right.
But the most important and often overlooked source is retained earnings. Simply plowing your own historical profits back into the operations rather than paying them out as dividends. It requires no bank approval and has no strict repayment schedule. They also use term loans from massive financial institutions, typically spanning 5 to 15 years.
But for the wavy line, the short-term needs, the landscape is much more dynamic. The workhorse is the commercial bank.
Yes, the banks.
They provide overdraft facilities, allowing you to draw your checking account negative up to a certain limit. They provide cash credits against your inventory. And they discount bills, meaning if you have a customer invoice due in 60 days, the bank will buy that invoice from you today for a slight discount, giving you immediate cash.
We also see heavy reliance on trade credit, which is simply leveraging your suppliers, getting them to agree to an open account where you can order materials and pay 60 days later without any formal debt instrument.
Advances are another great mechanism, convincing your customer to pay you a 50% deposit before you even begin manufacturing their product. Your customer becomes your financier.
And there's one more specialized short-term tool that I find absolutely fascinating: factoring.
Oh yeah, factoring.
Factoring is distinct from a bank loan. It is the outright sale of your accounts receivable. Suppose you have $1 million in outstanding invoices from various clients who are taking their sweet time to pay. A factoring company will step in and buy those invoices from you for, say, $950,000 cash today.
You take a $50,000 haircut.
You do. But the magic of factoring is that you not only get immediate liquidity to fund your operations, but the factor usually takes over the collection process. You completely eliminate your debt collection department.
Oh, wow.
The factor assumes the headache of calling the clients and demanding payment. It violently speeds up your cash conversion cycle, translating frozen receivables into usable cash today, albeit at the cost of a percentage of your margins.
Which brings us full circle. Every instrument, every policy, every calculation we've discussed today boils down to that fundamental tension. Are you willing to sacrifice a piece of your profit margin today to ensure you have the cash to survive tomorrow?
That is the core question.
We have covered an immense landscape of corporate finance. We started by stripping away the illusion of the income statement, proving that profit is meaningless without liquidity. We dissected the conceptual differences between gross and net working capital, realizing that Fortune 500 CFOs and small business owners fight entirely different wars on the same balance sheet.
We explored the devastating extremes of the Goldilocks zone. We saw how hoarding cash breeds laziness, obsolescence, and massive opportunity costs, while starving the business leads to abandoned growth, broken vendor trust, and the inevitable death spiral.
We tracked the literal heartbeat of the enterprise. We mapped the operating cycle and the cash conversion cycle, proving that time is the ultimate currency. We identified the macroeconomic and internal determinants that stretch those cycles, emphasizing the deadly paradox that rapid growth is the fastest way to run out of cash.
We built a conceptual model to estimate exact funding needs using the components approach, carefully avoiding the exam-killing trap of calculating debtor requirements based on selling price rather than base cost.
And finally, we explored the high-stakes poker game of financing, balancing the serene safety of the conservative approach against the lucrative, terrifying tightrope walk of the aggressive approach. If you can visualize the path of a single dollar, if you can watch it dive underwater as raw material, travel down the assembly line, sit in the warehouse, and finally surface as collected cash, you will not just pass an MBA exam. You will possess the operational insight required to steer a multinational corporation.
The mechanics of working capital are ultimately the mechanics of leverage and time. When you truly master them, you realize that the most powerful companies in the world aren't just selling products, they're engineering time.
That's a profound way to put it.
Consider the ultimate implication of the negative cash conversion cycle we discussed earlier. When a titan like Amazon or Apple achieves a negative 60-day cycle, they aren't just efficiently managing their own money. They have fundamentally altered the flow of capital in the global economy. By forcing thousands of smaller suppliers to wait 90 days for payment, the titan is extracting a massive, invisible, interest-free loan from the very ecosystem it relies on.
It raises a pretty serious strategic question. At what point does brilliant working capital management cross the line into predatory market behavior?
Exactly. If a small manufacturer goes bankrupt because a global titan refused to pay them for 120 days, who is truly at fault? The small firm for having inadequate cash reserves, or the titan for weaponizing its cash cycle?
That's tough.
The math of working capital is cold and objective, but the application of it shapes the survival of millions of businesses worldwide. It is a phenomenal lens through which to view modern economic power.
That is a staggering thought to end on. The balance sheet isn't just a record of assets, it's a map of leverage and power. Keep exploring those balance sheets, look for the hidden math driving the titans of industry, and never let the illusion of the income statement blind you to the reality of the cash cycle. Until next time, keep tracking those dollars.